The Federal Reserve is destroying the economy and they're going to send us into a recession. It's going to cause a lot of pain. People are going to lose their jobs. And if you stay to the end of this show, you're going to understand more about the Fed than 99% of people out there. You're going to know what they're likely to do at the November 2nd and December 14th meeting and when inflation will finally move lower. Hey, everyone. Welcome to the Dan Habib Show. I'm your host, Dan Habib. And a couple quick reminders before we get started. If you want the best advice in the mortgage and real estate industry, check us out at mbshighway.com. And if you want advice on investing in cryptocurrencies and you want an edge, go to CryptoCharged.com and use code Habib for 40% off. Boy, big volatility in the markets today. We heard from the mole at the Fed, Nick Timiraos. He is literally the Fed's source of leaks, and he tries to prepare the markets for what the Fed is about to do. Well, he wrote a piece in the Wall Street Journal today, and here's what he said. He said that the Fed is set to raise rates by 75 basis points and debate the size of future hikes. First, let's just explain for those of you that aren't aware what the Fed is doing. The Fed is hiking what's called the federal funds rate. This is intended to slow down the economy, to quell the biggest problem that we have out there, not just in the United States, but across the globe, which is inflation. The cost of goods and services is going up. You guys are feeling it, whether you go to the store, you go to the pump, things are costing more. Our dollar does not go as far. So the Fed has dedicated themselves to fighting this inflation at any cost. Well, when the Fed hikes, it does a couple things. It makes borrowing costs more expensive. Credit cards, car loans, it causes our treasuries to go up. It causes small business loans, personal loans to go up. And what they're trying to do is literally destroy the demand side of the economy to help reduce this inflation. It also has a bad impact on the markets. If you look at the stock market and equities, when the Fed hikes, it causes borrowing for businesses to go up. They can't expand as much. It also causes the dollar to increase. Now, that might sound like a good thing for goods that we import, but goods that we export, and we're very much a net exporter, they cost more now to foreign nations because the dollar has risen in comparison to their local currency. Well, that means that half of the earnings of the S&P 500, which is now overseas, well, that's probably going to go down because now we're not going to export as much business and our U.S. companies here are going to suffer. So when the Fed hikes, you see stocks usually go lower. Now, counterintuitively, if the Fed is able to achieve what they're trying to do and get inflation to move lower, and we'll go into that, you actually can see mortgage rates come down because they are most closely following inflation. So let's get back to this article here. So Nick Timiraos, the Fed mole, basically every time before the Fed has a meeting, and the next one's coming up November 2nd, he comes out and lays the groundwork for what the Fed is expected to do because the Fed does not want to come out and say it themselves, but they also don't want to shock the markets. Now, we already knew that the Fed was going to hike 75 basis points on November 2nd. That's been pretty clear, but this 100% confirms it. But the question is, what is the Fed going to do at their upcoming December 14th meeting, which is the next meeting? Now, if you look at the futures markets, they were pricing in a 75 basis point hike. But something new that we've been seeing is that the Fed members, some of them, are now concerned that the Fed is doing too much too fast and they are destroying the economy to too much of an extent. Here's the thing. When the Fed hikes, it's not like right away you see the impact. There could be a 6-month lag. So what some of the Fed members, including the Fed vice chair, who's very important, Lael Brainard, said is, hey, maybe we should start to slow the pace of this and then also begin thinking about stopping rate hikes sometime down the road here. This was new information that we're getting here. And Nick Timiraos basically coming out and saying that many of the Fed members now think maybe we should hike 50 basis points in December as opposed to 75. Now, the market saw this and they loved it because, as I mentioned, stock market doesn't like Fed rate hikes. Now, when you also see what the Fed may do, they want to keep their credibility because the Fed has basically said, listen, we are going to get rid of this inflation. So if the markets were expecting in December them to hike 75 basis points and they do 50, well, how can they get away with that and still keep their credibility? Well, Nick Timiraos suggests that maybe they can approve the 50 basis point hike, but then they can use their economic projections to show potentially some future rate hikes in 2023, more so than they had previously stated. But as a result of this, the markets loved it. But the bigger question at hand here is, when is inflation going to abate? We've seen inflation just going up, 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 especially when you look at the core readings, which strips out food and energy. When is this going to subside? Well, I got some good news for you. I believe that inflation may have already peaked. Now, when we look at the inflation reports, we get a new report each month. And if you add up the last 12 months, you get a year-over-year inflation reading. Now, there's two parts to inflation. You have the all-in headline number, and then you have what's really important, which is the core, because the core is what the Fed is focusing on. And as I mentioned, the core reading, it went last month on a year-over-year basis from 6.3 to 6.6%. It went in the wrong direction. But here's the way these reports work. They come out each month, and it is a rolling 12-month basis. Here's what I mean. We just got the September reading just 2 weeks ago, and what that does is replaces the September reading from 2021. So the lower the number back in 2021, the greater of a chance that we could see inflation in the current year-over-year numbers increase because the replacement number is a low bar. However, what do you see happening October and really going forward into the first half of next year? All of the comparisons, they get higher and they stay there. What that means is that if we continue to see some numbers maybe coming down a little bit lower, every month going forward, we can start to see some improvement in inflation on a year-over-year basis. The next reading, which is going to be a big one, is the October reading, which we will get November 10th. I promise you that is going to be a big day. But here's the other thing. If you look at inflation, the stickiest part right now is shelter costs. Shelter costs, if you look at the core rate of inflation, they make up 39%. And here's the problem with the shelter costs. The way the CPI calculates this, it's on a big lag. So what they do is about every 6 months, they are checking prices on rentals and what they call owner's equivalent rent. And they try to use a formula to try to bring it up to current prices, but it's not doing a good job. Why? If you look, July, it was 5.7% up on a year-over-year basis. August, it increased. September, it increased to 6.6%. So over the last 3 reports, you have been seeing shelter costs increase within the Consumer Price Index core report, and that has caused inflation to go higher. But if you look at what's happening in real time in the economy, the opposite is. When you see housing prices on a year-over-year basis, they've been cooling. That doesn't mean that home prices have been plummeting. What it means is the year-over-year gains have been coming down, which should be deflationary. When you take a look at rentals, it's the same thing. Rents at the peak were up 18.1% on a year-over-year basis. Well, now they're up 7.5%. So you see in the true market in current events here, you're seeing the numbers come down, which should be deflationary, but the shelter costs are increasing in the CPI because of the way that they calculate it. It's almost like a roller coaster. If you take a look at shelter costs in the CPI, you know when you're going over a roller coaster, if you're going up over a peak, the back half of the cart is still going up. You have the middle that's kind of at a flat level, and then you have the front of the cart that's actually going down. Well, the shelter costs in the CPI are still going up that hill, and you have real shelter costs that are coming down. But I do believe that this will catch up in January, and once we get past January, I believe you're going to start to see the shelter component of the inflation reports help us and help to bring prices lower. Now, take a look at why. The same exercise that we just went through with the core CPI figures, well, I broke out the shelter component of this to take a look at what the monthly numbers were from the last year. And if you take a look, we have to get past the January reading, which was very low at 0.3%. After that, look what happened to the shelter component from over the last year. It just went up, 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 almost in a straight line. What that means is after we get the January report going forward, I believe that you're going to not only be caught up as far as the lag that they have, but from a comparative basis, you're going to start to see shelter in the current market lower than these numbers, which is going to cause the overall CPI figure to move lower. Now, how about looking at other aspects of the economy? Yes, shelter's been sticky and been problematic, but I do think when you look at things like shipping costs, well, it's down 68% from the peak. We're actually at a 21-month low. This is looking at the Freightos Baltic Index, and Cass Freight, another company that reports what shipping costs look like, they've mentioned that the supply and demand imbalance has been easing, and they expect producers to have savings over the next several months, which is obviously deflationary. How about used cars? Remember when we were talking about used cars that were going up at an astronomical rate and how used cars were even more than new cars in some instances? Well, that has stopped. Over the last month, used car prices have gone down 2%, and on a year-over-year basis, they're down 10.4%. Clearly, these are deflationary figures. How about the money supply? The money supply is important. Here's why. When you look at inflation, the definition is too many dollars chasing too few goods. Well, we have too many dollars from all the stimulus, trillions of dollars of stimulus, as well as easy Fed monetary policy. They were doing all kinds of buying, they were injecting liquidity, and they were artificially keeping rates low, which promoted people to borrow and expand and put more money into the system. Well, guess what? Even though we've seen a 40% increase in the money supply, really from mid-2020 to a few months ago, we're starting to see that reverse. If you look over the last 5 months, for the first time since 2004, we're actually seeing the money supply start to decline. And our good friend, this is Lacey Hunt, he believes that by March of next year, we're going to see a more neutral level of the money supply and erase most of the excess out there that was created over the last 2 years from the Fed, from the stimulus. That's going to be deflationary as well. You're going to have less dollars in the system, less dollars chasing those goods. And as I mentioned, with shipping and things of that nature, if you start to see those supply chains ease up, there's reason to believe, team, that we're going to start to see inflation towards the end of this year come down. You're going to also see next year some really big improvements, especially when shelter starts going in the way of the market as it truly is now. And I think you're going to have the opportunity to see the Fed do a pivot, which is going to be a good thing for the markets.